All right, let's take another look here at the chart that I've provided for you guys before we dive into the content of Chapter 8. Again, we will have developed a master static budget, and we will have performed during the time frame, and we will be able to calculate our actual results for our cost and expenses incurred, including our variable overhead cost and also our fixed overhead cost. But what we want to do in Chapter 8 is calculate what would show in our flexible budget column using standard costing. We'll also take a look at activity-based costing, and once we are able to develop the number that goes in the flexible budget column, we can then compare our actual results to our flexible budget numbers and calculate a variance. Again, the difference between actual results and flexible budget numbers is referred to as the flexible budget variance. Okay, so that one's fairly easy to remember. Once we have gotten the flexible budget variance, you guys can still see that we can take that number and break it down further and calculate why was that a difference? Why was there a difference between the flexible and the actual results? Part of it is going to be due to pricing for what we paid for those items, and some of it will be due to efficiency or the lack thereof. All right, so let's dive into our content of Chapter 8. So Chapter 8, we're going to be, again, still looking at the flexible budgets, but we are going to be more specifically looking at overhead cost variances. And we're talking about our variable overhead cost and also our fixed overhead cost. Okay, and we'll of course talk about management control some more. So we do have several learning objectives in Chapter 8. Number 1, we are going to explain the similarities and the differences in planning for variable overhead cost and fixed overhead cost. Again, what kinds of things are we talking about here? Our variable overhead, those variable manufacturing overhead types of cost, are things like energy, our utilities, machine maintenance. Think about that. The more we run those machines, the more maintenance we're going to require, right? Okay. Engineering support, we're going to need more support the more we produce. Indirect materials, okay, these things are all variable in nature. Fixed overhead, what about our plant and equipment leases? Depreciation on property, plant, and equipment that we've actually purchased. Salaries of plant management. All right, think of the fact that these fixed overhead are things that have to be planned in advance of the period so that we can make those agreements, make those purchases, make those hires. And these are things that once we've signed up for them or purchased them, that it's not very easily done to eliminate those costs and expenses going forward. Yes, we may be able to sell off property, plant, and equipment if we can find a willing buyer. And what about plant management? We've got to have these people here, all right? So we may be able to terminate some of them, but these are costs that we are definitely going to be incurring. We've got to have somebody to run the show. Number 2, we're going to develop the budgeted variable overhead cost rates, and we are also going to develop the budgeted fixed overhead cost rates. And I've got formulas plugged in here for the PowerPoint slides for you guys to take a look at that. We are going to compute, once we know these rates, We are going to be able to compute the variable overhead flexible budget numbers, and then of course compare those to our actual results, and therefore we can compute the variable overhead flexible budget variance, which can be broken down further into the variable overhead efficiency variance and the variable overhead spending variance. We will also compute the fixed overhead flexible budget rate, and of course be able to compute the fixed overhead flexible amount for fixed overhead. We can then compare that to our actual results and calculate the fixed overhead flexible budget variance, which can then be broken down into the fixed overhead spending variance and the fixed overhead production volume variance. We will show how the four variance analysis approach reconciles with the actual overhead incurred with the overhead amounts allocated during the period. So again, think of the fact that our overhead gets allocated in. Think back to the concepts that you guys learned in Principles 2 and also your cost accounting class, how those manufacturing overhead related costs are incurred, and then based on some allocation rate, some predetermined allocation rate, that those things are allocated into those work in process costs of those items being produced. We will explain the relationship between the sales volume variance and the production volume variance, and we will calculate variances in activity-based costing as well near the end of the chapter materials. We will examine the use of overhead variances in non-manufacturing settings as well. As I have mentioned, we can do variance analysis even if we are some other type of organization besides just a manufacturer. So these are great concepts for everyone to use no matter what type of entity you will be working at later. All right, so planning our fixed and variable overhead is a very, very important process for management. So it's very essential that they understand the behavior of our overhead costs, how to plan for them, understanding how this variance analysis works and how it can be utilized to better run the organization, and hopefully acting appropriately based on the results that are calculated in the variance analysis techniques. Wherein our previous chapter focused on analysis of the direct manufacturing cost, our direct materials and our direct labor, this chapter is going to focus on planning and variance analysis of our variable and fixed manufacturing overhead only. Good overhead rates using a valid cost driver is the foundation of effective overhead cost allocation. Okay, so you guys learned in cost accounting how these types of costs are calculated, and then the fact that we want to put them into distinct groups where a valid cost driver can be utilized to help us to allocate those costs in to the items. So you guys need to understand that there are reasons to why we do what we do, and that of course there are also potentially some problems associated with expressing some items on a per unit basis. So when we get to talking about our fixed cost, we're going to talk more about the fact that we can break our fixed costs down on a per unit basis, but we need to use caution when we do that. All right, so to effectively plan our variable overhead cost, managers should focus on activities that add value and eliminate those that do not. All right, so in other words, value added. If it is not adding to the value of the product or the service that we are producing or giving to our customers that they'll pay for, aka value added, they will pay us for that value that we've added, then we really don't need to be doing it. All right, so if we can eliminate non-value added activities that, of course, we incur costs and expenses related to those activities, then we need to eliminate them if at all possible. Fixed overhead planning is similar. We need to plan only for essential activities, essential capacity, and plan to be as efficient as possible. All right, if we don't need a lot of square footage, then we don't need to buy a lot of square footage. If we don't need a lot of machine capacity, then why buy the extra large version of that machine? Why not buy the medium version of that machine? All right, so we have to be very, very selective in our planning process in regards to these overhead type of items. We've already talked quite a bit about standard costing in our Chapter 6 and Chapter 7 material. It is a costing system where we can trace direct costs to our output units by multiplying the standard budgeted prices or standard budgeted rates by the standard quantities of inputs allowed per unit for the actual units produced or the actual outputs produced. All right, we have seen in our past classes how we allocate overhead cost on the basis of the standard overhead cost rates that we calculate using that predetermined overhead rate formula. We take that standard overhead cost rate and multiply it times the standard quantities of the allocation basis allowed times the actual outputs produced. And that is how the amount is getting allocated in for those overhead related items. Again, if you guys have to go back and look at some of the stuff that you have learned in your earlier classes, Principles 2, these things are discussed in chapters 14, 15, 16, and 17, as well as 20 and 21 in your Wiley book for Principles 2, and I'm not sure about your cost accounting textbook, but you guys have definitely seen this multiple times now. Standard budgeted cost per unit of direct materials or direct labor is what we were able to calculate, and we would then multiply it times the standard budgeted inputs allowed of direct materials or direct labor per unit of production, just like we talked about in Chapter 7. And then we multiply that times our actual units produced. Now this right here is the formula for what goes into the flexible budget column. All right, let's look at our variable overhead cost rates and how we go about putting that together. We've got a 4-step process that we go through. Of course, step 1 is to choose the period to be used for the budget. Typically, we are talking about a 12-month time frame. And we will then come up with the cost allocation base that we're going to use in allocating variable overhead cost to our output produced. So for example, if we are a very heavily manufacturing based system using a lot of machine hours, then maybe we're going to use machine hours for our allocation method. What if we are labor intensive? Then maybe we're going to allocate our variable overhead using labor hours. Okay, so we're going to select some type of allocation base in order to use that in our calculation, and then of course track that allocation base and allocate in how much of variable overhead per whatever our base is. We will of course identify those costs related to the variable overhead and sum those up per the cost allocation base. And we're going to then compute the rate per unit of each cost allocation base used. All right, so we're going to come up with a variable overhead per unit of. All right, so here is what our formula would look like. We're going to take the dollar amount budgeted for the variable cost. We're going to then divide it by the quantity of the cost allocation base. Now, consider here, folks, that these are both estimated numbers. The estimated or budgeted total amount of the variable cost per this cost allocation base divided by the estimated or budgeted quantity of the cost allocation base that we expect during the period. And that's going to give us a variable overhead per unit of the cost allocation base. All right, and then once we've got that number, that is the number that we're going to use for our allocation process. Okay, so we're going to allocate the variable overhead to our units that we are actually producing by taking that variable overhead per cost allocation base and multiplying it times the standard allocation base allowed per unit. Okay, now that's what you guys have to make sure you've got straight. When we allocate it, it is by the standard allocation base allowed per unit. This is what's going to allow us to check how efficiently we're producing. We are expecting so much per unit. All right, so we're going to be using that standard in our calculation. And then multiplying it times the actual units produced. And again, this right here, this result that we're looking at, the number that we calculate here is what is going to go in the flexible budget column for our variable overhead cost. All right, so our flexible budget column is therefore flexed for the actual quantity produced. Again, notice down here, people, that this says times actual units produced. This is the flexing part. This right here is the cost allocation base rate that we've calculated. We've predetermined it. And then when we allocated it in, we've used the standard amount allowed of input per unit. And then, of course, multiplied it times that actual units produced. All right, so the amount shown in the flexible column for variable overhead is what management would have expected to incur for the quantity of output units actually produced. And then we're going to take this result right here and compare it to the actual results, what we've really actually had to spend on variable overhead. And then we're going to calculate the variances. All right, so the flexible budget shows the result of our formula, which I have already shown you once before already. And we can take and calculate first the variable overhead flexible budget variance. So again, it's based on those two columns, the actual result column on the far left, the flexible budget column result in the middle. We're going to compare those two. The difference between those is always called the flexible budget variance. Okay, doesn't matter what exactly we're looking at, but we're going to call it the flexible budget variance if it's direct materials, if it's direct labor, if it is our variable overhead, even our fixed. All right, so this variance, there's our formula, actual cost incurred minus flexible budget amount. Again, favorable or unfavorable. If our actual cost incurred are greater than our flexible budget amount, then it's unfavorable. It is more than what management would expect to see based on all of the things we've done to formulate putting that master static budget together with those standard costs and those standard inputs allowed, etc. All right. However, on the other hand, what if the actual costs incurred are less than the flexible budget amount? Then great, it is favorable. And let's look into why it's favorable. Is there anything we can utilize information-wise that we could share with other plants and divisions? All right, so in Chapter 8 text, we've got an example where we've got Web Company and they make jackets and they expect 0.4 of a machine hour to be utilized for each jacket or unit produced. They plan to produce and sell 144,000 units during the period. And based on all of their estimates, their total in their variable overhead for the period is expected to be $1,728,000. All right, that includes all of those variable overhead related expenses. Again, I mentioned some earlier, things like our utilities, machine maintenance, engineering support, etc. And we're going to calculate a predetermined rate. All right, so we're going to take the $1,728,000 in expected variable overhead cost, and we're going to divide that by the total number of machine hours that we expect to utilize in the period. All right, so how many do we expect to utilize? Well, it's 144,000 jackets at 0.4 of an hour each. Means we're going to have 57,600 hours for the year, or at least that's what we expect to have to utilize. All right, so if we take the total estimated variable overhead for the year and divide it by the total estimated allocation base here, this machine hours of 57,600, we get a rate of $30 per machine hour. All right, so as machine hours are utilized, we are going to allocate that in to our cost. And basically that breaks down to $12 per jacket. Every time we make a jacket, it should cost us $12 per jacket in variable overhead. All right, so breaking these things down on a per unit basis does help us to develop our cost, which of course will help us in pricing our units for sale, right? So we're hoping our marketing people are also paying attention in their other accounting courses. If we multiply this out for our budget, we are going to expect to see a total amount in our flexible budget column. All right, so again, the flexible budget is going to be based on actual results, but our standard cost and our standard inputs allowed therefore showing what management would expect to see for the actual quantity if all of our standards and all of our costing that we did in developing our master static budget hold true to form. Okay, so $120,000 is what we would expect to see, and that's going to be what shows up in our flexible budget. What our actual results are, whole different ballgame. Whatever we actually ended up spending on the different components that are embedded in this total $1,728,000 that was expected in variable overhead cost. All right, so we would track those actual cost incurred. Of course, those are the things that are coming in invoice format and payroll related and journal entry related regarding those expense type items. And we're going to tally all those things up. Based on our total actual cost, we have $130,500 total that was incurred, whereas what we expected was $120,000. All right, the difference between those two right there is the flexible budget variance, like we have already discussed numerous times now. But it can be broken down into the efficiency variance and the spending variance. All right, so what did we end up having in number of hours actually utilized, and then what was our budgeted rate? We can also calculate it down to what was our number of units produced and what was the standard hours allowed, and breaking that down. All right, so let's look at the efficiency variance item first. It is the difference between the actual quantity of the variable overhead cost allocation base used for the number of units actually produced and the budgeted quantity of the variable overhead cost allocation base allowed for the actual outputs. All right, so we said 0.4 per unit. 0.4 machine hours per unit is what was allowed. But what was actually utilized is a different story. All right, and we're going to take the difference between those two numbers and multiply it times the budgeted variable overhead cost per unit of the cost allocation base to get the variable overhead efficiency variance. We've seen formulas like this before that I've shown you. I might do a recap video at the end showing you those formulas typed out again in an Excel spreadsheet format. But you guys can take and write this formula out. Here it is broken down a little bit smaller for you. But again, you can take and abbreviate this information out to hopefully help you retain the formula. So again, actual quantity of variable overhead cost allocation base. We're talking about those machine hours on this particular example. The actual quantity used for the actual output, and then subtracting from that the budgeted quantity of the variable overhead cost allocation base allowed for the actual output. All right, so this second part right here, we had 0.4 hours of machine hours for each unit produced. So how many units did we actually produce is our actual output. Take actual output and multiply it times that 0.4. That is what a management would expect to see in the number of hours for producing X number of actual jackets. All right, so the difference between these two, did we use more hours than management had planned for. If that's the case, then we were inefficient. All right. If we use less hours, then hey, we've made some improvements in things, and engineering and production have made some improvements and efficiencies, and we need to discuss those and utilize that going forward and use that to better train future staff and share this information with other plants and divisions. All right. In order to calculate the total dollar amount for our variable overhead efficiency variance, we would then calculate that number and then multiply it times the budgeted rate, the budgeted variable overhead cost per unit of cost allocation base. All right. Looking at the spending variance, we switch the formula around just a touch. The variable overhead spending variance is the difference between the actual overhead cost per unit and the budgeted variable overhead cost per unit of our cost allocation base multiplied by the actual quantity of the variable overhead cost allocation base used. All right, so here it is spelled out again. Again, you guys have seen me put these formulas in an Excel spreadsheet, breaking down and abbreviating what's going on. Again, we're looking at the differences in the cost, the actual variable overhead cost per unit of the cost allocation base, and the budgeted variable overhead cost per unit of the cost allocation base. This is the one we have calculated. We had $30 per hour for our budgeted rate. All right, so calculate the difference between those two rates and then multiply that result times the actual quantity of the variable overhead cost allocation base that was used. And that's going to give you the spending variance. I will pick back up and do a separate video for the fixed overhead rates.